with very low volatility. It continued in January with fantastic returns until it didn't. So there's been a big correction, 10%, violent. It's quite a big move. And the reason, of course, are still debatable.
Well, Gilles, thank you very much for joining us today. It's a pleasure to have you in our studio. How are you?
I'm well, thank you.
Wonderful. So the last few weeks have been extremely turbulent for the markets and a perfect time for us to speak. Can you just tell us a little bit from your perspective what you make of all this?
Sure, with great pleasure. In markets, usually we say that markets go up with the escalator and they go down with the lift. And actually, it is exactly what we've seen. We had a fantastic performance in 2017. If you remember, like 20% for global stocks, 30% even in emerging markets, with very low volatility. It continued in January with fantastic returns until it didn't. So there's been a big correction, 10%. Violent, it's quite a big move, and the reason, of course, are still debatable. So there are a few questions of why it has happened. And the first question is, was it due to interest rates? Because we've seen interest rates going up steadily. The 10-year US Treasury up to 2.9% now. It's been quite a big move. But it's hard to believe that it was the main reason why we had this correction, simply because there's been no difference between the sectors. So interest rate sensitive sectors were beaten down exactly the same as the other sectors. So probably it wasn't the reason. The other question is, was it due to inflation? Because we've been speaking about rising inflation for quite a long time. On Friday, there's been this statistics about wage growth that has supposedly triggered this correction. But it's also very difficult to believe it was the main reason. Because if you look at the market implied inflation, the so-called break-even inflation, they had not moved much. And they should have, so it's very difficult to explain with only inflation. So the reason should have been more like technical. We've seen implied volatility is going up, a big rout in structured products related to volatility, and equity went down. It looks like a pullback and nothing else than just a technical pullback.
So with all this in mind, should investors reassess their asset allocation?
Well, that's of course the big question. Has anything changed? And if you look at the economic fundamentals or even the corporate margins, the earnings, nothing has really changed. There's no reason to believe that there's been a sea change that should trigger a different asset allocation. And I'm quite of the opinion there's no reason to believe that we should modify, say, the equity allocation going forward. It's more a technical pullback. We don't see any reason why we should change the asset allocation now.
So overall, you're fairly positive moving forward?
Moving forward, we're quite positive. We remain cautious. It's difficult to believe there is a V-shape. We had an acceleration in performances. It has come back to more normal levels. Will it exaggerate again? I'm not sure. So probably to see some opportunities and go back to a more neutral asset allocation is good now. But to be bullish and take a lot of risk today, maybe it's a little bit too soon.
Well, Gilles, thank you very much for speaking with us. It's been an absolute pleasure.
Thank you.
And thank you for watching. If you like this interview and would like to find out more, be sure to head over to dukascopy.tv.